There's just a lot of confusion out there, and a lot of opinion. And I thought it would just be wonderful to have the opportunity to have somebody like Manish on with us. I'm very glad he's taken some time to talk with us about the markets and what he's actually seeing. The reason that I feel that I wanted to invite Manish on is just to kind of give a premise for what they do. In the financial world, there are kind of two major camps of fund management, if you will. The one that's probably the most well known is buy and hold, right? That's where we go into a portfolio, and regardless of what the market does through the ups and the downs, we hold that portfolio. And so the strategy at this point in time for those types of managers is to wait out the storm and see how we do. And then there are tactical managers, which is what Potomac is. Tactical managers will adjust the portfolio based on what is happening in the environments. They'll move to cash to protect principal in big downturns, and then come back in when they feel it's safe. And so being how Potomac is that type of a manager, I really am looking forward to hearing what they have to say about current markets and what they're seeing. And one of the things I think is interesting about people as we kind of get into this, Manish, is I think people are always looking for a sign or a signal, right, about what's going to happen in the future, even down to, did the groundhog see his shadow? What color is the sky in the morning or at night? Will tell us what the weather's going to be. And the markets are no different. People are always wondering, well, what is the indicators? How do we know what the markets are doing? But one of the things that I wanted to ask you, I guess, in my first question, to help people understand a little bit more about our current situation, basically on March 3rd, in the Bull Bear Fund, you went 100% cash. You got yourself out of the market. Obviously, you must have seen something that wanted to make you move to protect the assets. So I wanted to just maybe ask you, what was involved in making that trade on March 3rd? What is it that you're watching that would have led you to make that trade?
Okay. Well, first of all, thank you for having us on. We appreciate the time to talk about sort of our strategies in the market. One thing that's important is there is no sort of magic sign that happens at the top and bottom of markets. It's more of a building block situation where over time you start to see signals deteriorate. And the way this bull bear system is set up, it's not just one or two signs that say go in or go out. Over the prior 3 months, we were seeing weakness in different indicators. And what I mean by that is, for example, volume, advanced decline, the amount of stocks making new highs versus new lows. And what you see is this cascading of different indicators giving sell signals. And there was a decline prior to March 3rd that sort of threw the rest of the signals into a sell. So, we don't future tell. We're not here to say, on March 3rd, we knew this was going to get worse. This indicators were starting to weaken to the point where, in our opinion, it was a better decision to go to cash and protect than take the chance of being fully invested. So to summarize, essentially, there's a bunch of market internals that we track when it comes to the behavior of the underlying stocks. And as we see trends change and stocks moving towards a downward trend, we sort of take action. And I always say back this, one of my sayings is, panic is okay. It's just better to panic early than it is to panic late. And that's sort of how the trade culminated on March 3rd.
Gotcha. Okay. So I think one of the things that I like about your style, and correct me if I'm wrong, Manish, but it's not emotional, right? It's not like, oh my gosh, I saw a news headline and I pulled the trigger. You're very oriented, and it's very non-emotional as to what you see. Would that be fair to say?
Correct. So, we build these systems in a quant fashion where as the underlying data changes, we really could care less if there's a virus from an investment point of view. Of course, from other points of view, we care. But in terms of our systems, it doesn't matter what's going on in the world. It doesn't matter what the geopolitical risks may be or the headline risk. It just comes down to the actual numbers. And as the market changes and the landscape changes, the systems will sort of give us a heads up whether we want to be risk on or risk off.
Gotcha. Okay. Well, that's probably being a little bit non-emotional right now is super helpful with everything going on and kind of the unprecedented markets that we're in. And just to also kind of set up a little bit more about you as we move into talking about the current situation, can you explain like why you feel being in cash is actually an active tool for Potomac?
You know, the thing with cash is, especially like say the last 10 years, it gets a bad rap, right? One man's trash is another man's treasure. And there's times in market where there's so much price dislocation that nothing works. And a good example of that is you take something like utilities and real estate, which are historically defensive sectors. They're all down plus 25% so far year to date. And so I wouldn't necessarily consider that a defensive sector. So there are times where, you know, the old saying, you throw the baby out with the bathwater, where nothing works except for cash. So in our opinion, sometimes the only defense is to just sit it out. Let it play out and then pick your spots to get back in. You're never going to call it exact. You're not going to call the top exact. You're not going to call the bottom exact. But there are absolutely times where you should just not be invested in anything until the landscape changes.
Gotcha. Okay. And one question that I had from one of my clients that I thought I'd mention before we get into the current environment was, so are these guys just a one-hit wonder? Did they happen to get March 3rd right? Or, you know, do you have a track record of actually avoiding large downturns in the market?
Yeah, I love this question because, you know, the track record's in place, but I want to give you the pros and cons. It's not perfect, right? So in like a 2008, we were able to avoid a lot of the massacre, but it took us time to get back in the market. You just have to be comfortable with what the pros and cons are of any investment strategy. There is no strategy that's going to avoid all the losses and get all the gains. That's just not realistic. But if you are willing to maybe not get as many gains on the upside, there are strategies that consistently mitigate the downside. Now, all investing incurs risk. So let's get that out right there. There's no investment that's going to be risk-free. But what we do is our goal is to avoid the catastrophic losses. And so to us, a catastrophic loss is, you know, 40, 50% drawdowns in the market, because for people approaching retirement, you know, it's sometimes impossible. You don't have enough time to make up for those losses. And so, yes, we do have a track record of avoiding those catastrophic losses because we're risk averse and we sort of take risk off the table during, you know, volatile periods.
Right. Okay, awesome. Well, I want to spend some time. So that kind of sets up a premise, I think, about who you are. Many of the people on the call actually have funds with you. And I think it's a great opportunity for them to kind of meet you a little bit. So I want to discuss a little bit about where we're at now, right? So a lot of damage has happened. We've seen the markets tumble pretty well. A lot of people are starting to see headlines, you know, whoever they follow, okay, we're at the bottom. It's time to jump back in. But again, you're watching non-emotional indicators. And so I guess my first question to you about that would be, you know, where are we at and how have, I guess, bear markets in the past behaved? Is this one any different?
Yeah, I actually saw a headline in the Wall Street Journal where someone said, you know, the bull market has begun. You know, the Dow's up 20% in 3 days or something like that. Once again, emotional headlines, it's easy to get caught up in that. Even as a money manager, you see the market jump 10% in 1 day and you know, you're like, hey, you know, what did we do wrong? Why aren't we in? But you have to go with the simple fact that we are in a downtrend. It's currently a bear market, and bear market rallies happen all the time. So between 2000 and 2003, during that bear market, there were actually 4 distinct rallies of 19, 21, 21, and 21%. So at 4 different times, the market did have a 20% increase, which some people would consider a bull market. And so it's these sort of bear market rallies, they're commonplace. And in fact, the most volatile days happen in downtrending markets because you get this emotional trading where people are getting in and out of the market. So, you know, we kind of stick to the numbers and, you know, we're still in a downtrending market. We feel that we're still in a bear market, but those opportunities will come, but they're just not here right now. And you can't get sucked in with these short-term rallies that are normal in this type of environment.
Right. And one of the questions I think a lot of people are wondering is that I think there's a similarity between 2008 and now, in that we had this government stimulus pass, right? In 2008, there was TARP and there was other types of stimulus to try to help the economy. But going back to your point, I think that there was a rally after TARP was passed in '08, but it wasn't the bottom. Is that correct?
Yeah, so actually there was two 10% rallies separated by only a couple of days, I think in October. And then, we had a mini rally around Christmas time, and then we eventually fell another 25%. So once again, these headlines are great, and sometimes they might give you a short-term boost, but in a down market, sometimes there's nothing that can help. And so, you got to sort of stick with the numbers. And so 2008 is sort of a great example because the market bottomed the first week of March, but our systems didn't necessarily get back in for a couple months because we're not trying to catch that falling knife. You want to see a bottom happen, and then you want to see some uptick so you feel comfortable putting capital to work. The only way to catch a market at the absolute bottom is to get every decline from the top. And sort of our process is to lessen the volatility of that roller coaster. And that's sort of the whole theory behind tactical risk management.
Gotcha. So basically, just to summarize, and hopefully we're keeping it simple here and not getting too deep in the minutia, but right now your indicators are saying we may not be at the bottom, and you're not going back in at this point. Is that fair to say?
Yeah, at this point, the way it's lining up, we don't feel that a bottom has been put in yet. There's still going to be some more pain. However, at the same time, we're already sort of down 30%. So, if we do make a lower low, which is what we think is going to happen, there will be opportunities in the near future. There's just so many unknowns. We've never gone through this as a country in terms of the economy stopping. So it's treacherous to start picking bottoms. You preserve capital, you get out of the way, and then as the market evolves, you'll have plenty of opportunities to start putting capital to work. But as of now, we don't feel that the bottom has been put in yet.
Gotcha. Okay. And would you say that by looking at some of the numbers you look at, if this was a bottom, is there some pretty good opportunities there, good buying opportunities, good values?
Yeah, it's a double-edged sword, right? Because you have, let's say price to earnings, right? Price has come down and you can say, wow, it's a valuation, but we don't know the numbers from the companies in terms of earnings because things have essentially been shut down. So as earnings start coming out, maybe you go back to an overvalued situation. So it's really hard to make that prediction because we just don't know. Like, here's a great example, the jobs report that comes out tomorrow. It's going to be scary, but the jobs report actually stops on March 12th and only gives you a week of data. So even though it's going to be scary, the April one's going to be a hell of a lot scarier. And so sometimes you can't get caught up in sort of the headlines and what people are screaming. You just got to stick to the numbers. And as of now, we don't see there's much value in trying to pick places. You can make the argument there's certain stocks that you should go after that will do well in a pandemic, things like that. But you just don't know because it's such a new situation for us.
Awesome. Well, and I think this is a great opportunity for my clients and friends to see that this is, people that I talk to on a regular basis, and it's wonderful to have somebody like you guys keeping a track of this as we go through some turmoil like we have. So if I can ask you, Manish, if it's okay, how does Potomac progress or approach the markets going forward from where we're at right now?
So we have specific indicators we look at. There's capitulation indicators, which basically there's data you can look into where investors just throw in the towel and start indiscriminately selling things. There's volume that we want to see balance out. Like even on these past up days, on the strong up days, the volume has actually been negative, which means that more money is chasing declining stocks than there is advancing stocks. And so you want to make sure these underlying abnormal activity sort of balances out. So we're looking for volume to steady. We're looking for the amount of advancing stocks to outpace declining stocks. And once again, that's going to happen after a semi bounce. You're not going to get it right at the bottom. But so volume, market internals, you want to see the underlying health of the market stabilize. The best analogy that I've ever used is just a patient and a doctor. You know, if you go in and you have issues and high blood pressure, high cholesterol, high triglycerides, you know, you really can't start trading for a triathlon until some of that stuff comes down, where you normalize some of your numbers. And that's what we want to see. We want to see healthy up days. We want to see sectors performing on healthy upswings that are supposed to perform. Right now, on this recent upswing, you had things like utilities and real estate that were at one point in time considered conservative investments, defensive investments, outperforming tech and everything else. And that's not necessarily a healthy advance. So we're looking for some of those numbers to normalize. And at that point, we'll be able to assess if it's time to get back in.
Gotcha. Okay. Awesome. So if you were talking to, and we are talking to some clients here, I mean, in conclusion, I guess, what should be their takeaways from kind of some of the conversation we're having today about the current environment and what you're seeing?
You know, I think I'm always a big proponent on self-awareness. Every client needs to work with an advisor to figure out what they're comfortable with. If your risk level is high enough, maybe you want to take a chance and nibble on some equities here. It just depends on what you're comfortable with in terms of an investor. I think the biggest takeaway is, you know, you could start today as an investor, and maybe 20 years from now, you get to the same place buying an aggressive investment as you would a conservative. But along the way, you're going to go through different periods of time that are going to tug on your sort of emotional chains. And it just comes down to what you're comfortable with. You know, I wrote the other day in a blog that a roller coaster, you know, it gets to the same place, but Potomac is just making sure that we take away the peaks and valleys so you don't barf on yourself along the journey. And that's really true. It's how much, you know, how much do you want to sleep at night knowing that, you know, we could have even more pain than we've already had. So it just comes down to your risk level, what you're comfortable with, obviously working with someone like you to develop a portfolio. And we tell people, you know, this is a slice of the pie. It's up to the advisor and the client to decide how to allocate that pie. But this is a slice of it to sort of lessen volatility.
Right. Okay. Awesome. So have you guys seen shelter in place? I don't know what your area of the country is doing right now. Is that affecting the practice at all, or are you guys still at work like usual?
Yeah, we're sort of spread out. This has been something that we've done for years, so we have the systems in place to handle this. So, you know, sheltering in place is sort of like a normal work week for us. We're kind of spread out, and we use technology and different backups to handle this stuff. And I think the best thing is, like you said earlier, being able to still have these conversations, talk to clients, then being able to log in and get updates. I think, you know, if this happened 15 years ago, it would be a much more trying time, right? So I'm grateful for you know, being able to use the tools that we have in this type of situation, and being able to be healthy and you know, going through this for sure.
Awesome. Well, I have to tell you, I'm grateful for what you guys do. You know, behind the scenes, we have a team of people that we use for different pieces of advice. So a lot of times when the markets get bouncy, one of the first things I do, to be honest with you, is I pull up my Potomac funds and I say, well, what's Manish doing? You know, because I know that you got a beat on this stuff, and you've done a very good job in protecting our clients. And so I appreciate that. And one of the things I really want to just, a rare opportunity that someone like you would get on a call with us and be able to just give us your insight about what you're seeing with all this turmoil going on. Jeff, I don't know if we have we want to take a couple of questions, see if we can answer some of those.
Sure, we've gotten a few of them come in. We need to be a little bit selective here for out of respect to time. There is a good question here. Is it worth taking the loss now and moving to cash since the current situation is so uncertain? I've also heard the old logic to just stay in for the long term, and over time it'll make up the loss. So really asking for some perspective there.
Once again, this is something that I think clients need to sit down with Rich and discuss. And I will say this, I'm a market historian. So to me, has something like this happened in the past? You look at the Great Depression, where it took 25 years to recover from the bear market. Sometimes, yes, you may, the thing that they always say is eventually you will make your money back. But does that eventually line up with your time frame? So it just depends on how much time you have towards needing that money and your retirement. And if retirement is in the near future or it's something you plan on doing, then you may not have the time to make that up. And that's just how the pie is allocated, depending on how much that eventually you have.
Okay. I would definitely, second that.
Okay. Yeah, okay. So we have time for one more question. And it was in reference to something that Manish had mentioned earlier, which is, can you explain the term drawdown?
Okay. Yeah, that's a good question. So drawdown is a calculation that takes the peak to trough loss of any investment. And one of the reasons we love doing that is there's all these other fancy stats that can confuse investors, but drawdown is one thing that you can never hide or run from. For example, if you own, let's say, an oil and gas mutual fund, for example, and at one point in time, from its highest peak to its lowest decline, it declined 60%. That's the ultimate pain that you should be willing to suffer to invest in an investment like that. And so the drawdown is just a calculation of the biggest loss an investment has ever taken in its history. Now, it may have recovered at some point, but you also took that loss in at some point as well.
Okay, perfect. I think in the essence of time, that should probably end it up. There were a couple of other questions that will need a little bit more explanation. And so we want to do a couple of things. Rich, you're going to be able to, of course, we're going to send out a follow-up email to everybody, just like the invitation. And you have a chance to, all the attendees have a chance to put another question in there. Obviously, Rich will reach out to the couple of folks that had some additional questions here that need a more lengthy response. Anything else that we can do at this stage, gentlemen? I know I'm going to share some disclosure and contact information right now. So there we go. There's the contact information. Any parting thoughts, Rich?
No, I just, again, I really wanted to thank you guys for taking time to spend with us. And I'll be reaching out to everybody that has questions, because at a second, what Manish said, all of these situations are very client specific in a personal situation. And we'll be reevaluating with everyone, over this next couple of weeks to see if we need to make changes or if we can continue to ride out the storm. So, but again, thank you so much, Manish and Jeff, for taking time to spend with us and giving us your insight.
Sure enough.
Thank you. Yep, we appreciate it. Any questions, Rich, send them over my way. We can discuss them together. I'm more than happy to spend some more time answering any specific client questions.
Okay, sounds great.
Thank you very much. Stay safe.
Bye-bye.
Thanks, guys.